Alright, so for our master presentation, I really wanted to look at investing because I want to be a hedge fund manager, and I thought the best way to do that was to learn about investing. So I wanted to create a unique investing style that's separated from everyone else so I could get a job, hopefully in the future on. And the best way to do that is basically learn what investing is. So I thought the best way to do that was to get a internship. So I went to an internship every Friday at a company called BTIG, which is essentially like the second or the third biggest private equities fund and hedge fund in essentially the world. And I worked with a person hands-on, and we learned about several different things. But through the time constraint and how big I wanted to do my project, I wasn't actually able to accomplish a lot. So what I was able to do was I was able to learn, but I was able to create an individual style. So I'm just going to walk you through what I learned and how I learned it. So we started off very simply. It's like, what is an asset class? So asset classes are essentially anything you can invest in. The main three ones are equities, which are stocks, fixed incomes, which are considered bonds, and cash equivalences are anything that can be traded very fast. So stocks are basically medium-term investments. You can sell them fast, you can sell them long, you can basically have them for the long hold or short hold. And a lot of times they're either high risk or very low risk, depending how much money you put them on. But they're usually pretty steady unless you have like certain places where you have like a stock market crash. So for bonds, they're very, very steady, but they're very, very long term, and they're not very profitable because you only get, because a lot of them are government officiated, and you only get like 5% return, but with the stock you get anywhere to 100% return. And cash equivalencies, they're very short term and they're low risk because they're being traded so fast that it's like essentially if you were trading currencies. So if you wanted to get, I don't know, like 1,000 euros for $110 because you think the euro is going to go up. So they're usually low risk and short term. So after we learned that, we talked about how assets react in different environments. So we learned about essentially what they call climates, which are different times in the fiscal year or in the overall economy, how they perform. So in a recovering from a recession, equities perform well, not best, but they perform still well in the growth phase. So the reason they perform well is because in the growth phase, the dollar is usually at its highest point, making the stock price at its highest because the dollar is worth less. So essentially, with inflation, it kind of increases. So if you were to buy a stock at, let's say, $100, and then usually interest is 2%, so you get 2% on every single thing you did, and that's without even the stock going up. That's just simple interest. And the economic peak, it usually does very well because essentially does it well. The only time that the stock doesn't do well is in a recession. As we all know, the 2008 crash, in 1984, I want to say, there was another crash and the stock just plummets. So fixed incomes, as we talked about before, were bonds. Bonds performed essentially well overall, except for when you're in an economic peak, because at this time, interest at its highest point, and because fixed incomes don't account for inflation, and inflation